Open on a bank statement. A number that hasn't moved in 5 years. Here's something strange. You did everything right. You didn't panic buy a house at the top of the market. You didn't gamble on some coin your cousin swore was going to the moon. You opened a savings account like you were told to. You watched the number go up month after month, and you felt good about it. And yet, if you check today, you're poorer than you were 5 years ago. Not because you spent more. Not because the bank stole from you. The number in your account is still climbing. It never stopped climbing. But somehow you can buy less with it. That's not a glitch. That's not bad luck. That is the system working exactly as designed. And the strangest part? This isn't happening during some dramatic inflation crisis you'd see on the news. This is happening right now, quietly, while headlines tell you inflation is cooling down, low inflation, rising prices, shrinking savings, all three at the same time. Stick around because by the end of this, you'll understand why the safest financial decision most people make is also one that's slowly working against them, and why almost nobody explains this part out loud. Let's start with the headline you've probably seen a version of. Inflation falls to its lowest level in years. Sounds like good news, right? Prices calming down. Crisis over. Go back to normal life. Except inflation is falling doesn't mean prices are falling. It means prices are still rising, just more slowly than before. Here's the part almost nobody stops to explain. Inflation isn't a fever that breaks and disappears. It's more like a treadmill. When someone says inflation dropped from 6% to 3%, they are not saying the treadmill stopped. They're saying it slowed down. You're still walking. Your legs are still moving. You are still going nowhere, just at a gentler pace. And here's the trap hiding inside that good news. Most people hear low inflation, and their brain quietly files it under safe. They stop worrying. They stop checking. They leave their money sitting exactly where it is, because 3% doesn't sound scary. 3% sounds fine. But your savings account isn't earning 3% to match it. In a lot of the world right now, savings accounts are paying somewhere between 0.5% and 1.5%. Some pay almost nothing at all. So do the quiet math with me for a second. If prices are rising 3% a year, and your money is growing 1% a year, you are losing 2% of real value every single year while your balance goes up. That gap, that 2% gap, that's the part nobody puts in the headline. And it compounds. Silently. Every year you don't notice it, it gets a little bigger, like a slow leak in a tire you keep meaning to check. This matters right now specifically because interest rates on savings accounts have been falling in a lot of places, even while prices haven't gone back down to where they were. Everyone's relaxing about inflation at the exact moment they should be paying closer attention to what their money is actually doing while they sleep. So let's break this down properly. Not the textbook version. The real one. Money has two identities. There's the number identity, the digits sitting in your account. And there's the purchasing identity, what those digits can actually buy you. Most of us were trained since childhood to only watch the first one. The number. Line goes up, life is good. Nobody sat us down and said, hey, also track what that number can buy. Here's a simple way to see it. Imagine 10 years ago, a basket of groceries cost you $100. Today, that same basket costs you around $130. Nothing changed in the basket. Same bread, same eggs, same milk. What changed is what your money is worth against that basket. Now put $100 in a savings account 10 years ago and let it sit, earning a small interest rate. Depending on the bank, you might end up with somewhere around $110, maybe $115 today. You have more dollars. You can buy less groceries. That's the entire trick, laid completely bare. Your money grew. Your world got more expensive faster than your money grew. The two lines look similar on a graph, close enough that most people never notice they're not actually moving together. Banks are not lying to you when they show your balance increasing. That number is real, but it's answering the wrong question. It's telling you how many dollars you have. It's not telling you what those dollars are worth. And here's a small, quietly funny detail buried in this. Banks advertise savings accounts using the word grow. Watch your money grow, they say. Technically true. Your money is growing. It's just growing slower than the cost of everything around it. It's like being told you're winning a race while the finish line keeps moving away from you faster than you're running toward it. That's not growth. That's an illusion of growth, dressed up in a green up arrow on an app. Now here's where it gets uncomfortable because there's a name for this, and once you learn the name, you can't unsee it anywhere in your financial life again. Economists split every return into two versions. The nominal return, the number the bank shows you, and the real return, what's left after inflation eats its share. The formula is almost insultingly simple. Real return equals nominal return minus inflation. That's it. That's the whole hidden mechanism. No conspiracy, no trick clause buried in page 9 of your bank agreement. Just subtraction. But subtraction that almost nobody actually performs because banks show you the nominal number in giant bold font, and they never show you the real one at all. Let's run real numbers slowly so this actually lands. Say your bank pays you 1% a year on your savings. Inflation is running at 3%. Your real return is 1 minus 3. That's negative 2%. Negative. You are losing 2% of real value every year while your statement proudly tells you that you earned interest. Now stretch that across 10 years. A negative 2% real return compounding doesn't just erase 2% of your money once. It erases it year after year off a shrinking base. Over 10 years, that quiet 2% leak can eat somewhere close to a fifth of your money's real value. Not because anything dramatic happened. Because you did nothing for a decade while a formula you never checked worked against you the entire time. Here's the part that should actually unsettle you. This isn't a rare event. This is the default state of a normal savings account in a normal economy in a normal year. Losing to inflation isn't the exception. Keeping up with inflation is the exception. Most banks aren't in the business of protecting your money's value. They're in the business of borrowing your money cheaply, lending it out at a higher rate and keeping the difference. Your 1% interest isn't generosity. It's the cost of doing business, set as low as the market will tolerate. And the market tolerates it because most people never check the real number. They check the nominal one. They see it go up. They feel safe. The system depends on that feeling. Now let's talk about what you're told versus what's actually happening. The hype says, saving money is responsible. Saving money is safe. Saving money is what smart, disciplined people do, while everyone else is out there recklessly spending. And to be fair, compared to spending everything you earn, saving is absolutely the better move. Nobody's arguing against having a cushion. But here's the reality hiding behind the hype. Safe and growing are not the same word, even though we've been trained to treat them like synonyms. A savings account is safe in the sense that the number won't suddenly drop. It won't crash on a bad Tuesday like a stock might. Your bank isn't going to text you at 2 a.m. telling you you've lost 40% overnight. But safety from sudden loss is not the same as protection from slow loss. And slow loss is exactly what a savings account, sitting there earning less than inflation, is quietly doing to you. Here's the irony, and it's a heavy one. The exact behavior that feels the most responsible, parking your money somewhere safe and just leaving it, is often the behavior that guarantees you lose value over time. Meanwhile, the behavior that feels riskier, actually engaging with where your money sits, comparing rates, understanding inflation, occasionally moving it somewhere it can outpace prices, is the behavior that actually protects you. We built a culture where doing nothing with your money feels like virtue. And doing nothing is exactly what a system that profits off your inattention is counting on. There's also a strange psychological trick at play here. Losing money to a market crash feels dramatic. Feels like something happened to you. You'd notice it, you'd talk about it, you might even change your behavior because of it. Losing money to inflation feels like nothing happened at all. Your balance still goes up. There's no red number, no alert, no crash to point to. The loss is real, but it's invisible. And invisible losses don't trigger the same alarm in us that visible ones do. That's precisely why this one slips past almost everybody. Now let's pull back further, because this isn't just a personal finance quirk. This is structural. Governments and central banks generally aim for a small, steady rate of inflation, often somewhere around 2% a year on purpose. Not as a mistake, not as a side effect, as a target. Why would anyone want prices to rise every year, forever, by design. Because a small, steady rise in prices keeps an economy moving. It nudges people to spend and invest rather than hoard cash under a mattress, because cash sitting still is quietly losing value, which pushes money to flow into businesses, into markets, into activity that keeps the whole machine running. But here's the uncomfortable part nobody says out loud in the press conferences. If inflation is designed to make cash lose value over time, then cash sitting in a low-interest savings account is, in a very real sense, designed to lose value over time too. It's not an accident of the system. It's closer to a feature of it, which means the entire premise millions of people were raised on, work hard, save your money, put it in the bank, watch it grow, was only ever half true. The saving part is fine. The put it in the bank and stop thinking about it part is where the quiet erosion happens. Zoom out even further and you'll see this pattern repeat across entire generations. People who saved diligently in low-interest accounts through decades of mild, boring, headline-friendly inflation often ended up with less real purchasing power at retirement than they expected. Not because they didn't save enough dollars, but because the dollars themselves kept quietly shrinking in what they could buy. This is why some of the wealthiest, most financially literate people you'll ever study don't hold large piles of cash sitting idle. Not because they're reckless, because they understand that cash has a built-in expiration date on its real value, and letting large amounts sit still for years is its own kind of risk, just a slower, quieter one than the risks people are taught to fear. The uncomfortable truth is this. We've spent decades teaching people to fear the visible risks, market crashes, bad investments, scams, while the risk that's actually eroded the most wealth for the average saver has been the invisible one, sitting quietly inside the very account they were told was the safe choice. So where does that leave you? Not with a stock tip. Not with some app you should download. This isn't that kind of video. It leaves you with a question that's harder to sit with than any of the numbers we just went through. If the safe option was never actually protecting your money's value, just protecting it from sudden, visible loss, then what does safety even mean in a system that's quietly designed to make standing still expensive? Because here's the thing. You can't opt out of this. You can't choose an economy with zero inflation and a savings account that pays you fairly for the risk of doing nothing. That system doesn't exist, and it's not going to. What you can do is stop mistaking a rising number for a rising fortune. Start asking the second question every time someone shows you the first. Not, what's my balance? What's my balance actually worth? Most people will finish this video, nod, feel a brief flicker of concern, and go back to checking their app the exact same way they did yesterday. The number will go up a little. They'll feel fine. The gap will keep widening quietly underneath that feeling. The question is whether you're going to be one of them, or whether you're finally going to start checking the number underneath the number.